thank you for such a kind introduction and as well as giving me an opportunity to present on this very important topic and which is going to be the current theme, so to say. So without wasting much time, I will straight away jump on to the topic. And so, we can get started. Just one or two points. So, this can be as interactive as possible. So it is completely fine if questions are posted, in the course of the webinar. And, we can, if possible, we will try and deal with them, or of course, we can deal with them later at the end of the session.
Kushal bhai, we have a model whereby for the initial 90 minutes to 100 minutes, the speaker speak, and whoever participant wants to raise any question, he will put on a chat box, and the last 20-30 minutes, the speaker address to those question and answer to make things easier.
Perfect. We then go by that model. Yeah. So then let's just straight away jump into the topic. Ashita, we can move to outline. Yeah, so let me just spend a minute or so to sort of discuss what we are going to cover today. So first, we cover the economic scenario, just get a brief understanding so as to understand the context and the gravity of the situation. Thereafter, we kind of deliberate a little bit on life cycle of a typical business which is under stress. Ashita, you can load this slide completely. It's okay. So, yeah, we then look at the life cycle of a stressed business. We understand what different phases it goes through, and where in which phase what kind of restructuring may be of relevance. Then we look at a little bit in more detail about the resolution framework, specifically under the RBI framework, which is outside of IBC. And then we go on to look at the resolution framework under the IBC. Then we deliberate on tax and structuring issues, and then look at some case studies, and then probably conclude on that basis. Moving on to the next slide. So let's look at the economic scenario. So even before the COVID, our economy was already in slow lane. GDP had already declined to 4.7% in Q3 of FY20. We remember the days, now in fact, nowadays 7% is also kind of a dream. So those are the days that India was even before COVID. Another important piece of statistics, which is kind of particularly relevant from the perspective of stress, is that corporate profitability was at a record low of 2.8% of GDP. This is a 2018 number, but very important number because let's say a decade ago or so, corporate profits as a percentage of GDP were around 7-8% of GDP. So as profitability declines, it results into stress in terms of servicing of debt and etc. So it is evident that the economy as a whole was generally under stress. GNPA, gross NPA ratio of banks continue to remain elevated at 9.3%. It used to be around 11% a couple of years ago. So there was some reduction, but 9.3 is still a very high number. And so to say, initially this was a twin balance sheet problem, which kind of transformed into a four balance sheet problem. Let me just explain that. Ashita, please load the entire slide. Yeah. So when I say twin balance sheet problem, initially the stress was seen in sectors such as infrastructure, power, steel, manufacturing, right? And on the other hand, we had banking system, which was facing the stress. Post demonetization, that stress transgressed into other sectors. So one of them was real estate. And we then saw not only banks' balance sheet being stressed, but also that of NBFC sector. So we saw collapse of IL&FS, we saw collapse of DHFL and the insolvency resolution which has started in case of DHFL. So from banking system, the stress spread across to non-banking side as well. And from initial stress in a few sectors such as manufacturing, power, infrastructure, the stress moved to real estate and other sectors as well. Now, COVID is only going to make bad things worse. So lockdown is having a severe economic impact. GDP, there is not likely to be any growth. GDP is likely to remain flat, and worst case scenario is that it may in fact shrink. And many new sectors which hitherto were not seeing any stress are likely to or are beginning to going to see the stress. And this includes things like hospitality, air travel, white goods, leisure, entertainment, because as everybody prioritizes cash conservation, even households are unlikely to spend on discretionary items. So even these sectors may going forward may see a stress. Moving on, let us now spend some time and sort of put all this economic backdrop into thinking from a micro perspective and look at a specific business. If we can move to the next slide, please. Yeah. So yes. So typically, a stressed business has three different phases. The phases are the first phase is sort of turnaround phase, where the basically the revenue has started declining. There is cash crunch. There is asset liability mismatch. Operations are at a suboptimal level. And some of the things that become focus during this turnaround phase are kind of managing liquidity. One tries to rationalize cost, revisiting CapEx, whether it needs to be done or it can be deferred, try to revisit the headcount and try to see if, depending upon the demand outlook, whether the number of employees remains right or not. And basically overall focus is stabilization of revenue and margins. So here the focus is much more internal, and one tries to do course correction. So this is kind of the first phase in case of a life cycle of a stressed business. If the turnaround efforts do not yield results and do not yield right fruits, then the business moves into so-called restructuring phase. Here, not only in restructuring phase, you not only try to do things which you try to do in turnaround phase, but over and above that, one starts looking at sale of non-core assets and businesses. One tries to think if one can raise equity or debt finance to provide further support to the business. One tries to seek refinancing opportunities in respect of the debt, especially where your current debt is a high cost debt, and opportunities are available in the market to refinance at a lower interest rate. And one also tries to engage with creditors to see if there is any kind of financial restructuring possible. This may involve things like deferment of the installment payments, correction in the rate of interest based on the prevailing market rate, re-agreeing schedule of payments. This is still a stage where actually default has not occurred, but you engage with the creditors, in advance to try and mitigate a potential default. And and one can also pursue and try and see if we can merge with a stronger player in the market to sort of save the business. Now, if the restructuring efforts also kind of fail and do not yield result, then kind of stressed business moves into resolution phase. So here comes the aspects around statutory resolution framework, such as RBI framework that we have, and as well as framework under the IBC. This is kind of a last stage where probably a default has already occurred. The business has not lived up to its commitment to its creditors, and then the whole effort goes into how do you resolve the insolvency. So in today's webinar, what we are going to strongly focus is particularly this aspect around resolution, because that is where a lot of regulatory framework as well as tax and other issues come into consideration. Restructuring phase obviously also has a lot of potential, and certainly many of these things will have tax issues and tax considerations, but those are kind of general and applicable in all types of mergers and acquisition or restructuring scenarios. So we will try to focus on the resolution bit and try and see what is the regulatory framework and how does the tax issues resolved around that. We can move to the next slide, please. Yes. So now let's spend some time in trying to understand the RBI's framework. And there is a bit of history as well here. There is a bit of history as well here. So good to gain a proper understanding of the same. So RBI framework is essentially contained in RBI's direction of June 7, 2019, which is the resolution of stressed assets directions. So prior to this June 7, 2019 circular, there used to be several different mechanisms for resolution and for restructuring, which the RBI had initiated. This included things like corporate debt restructuring scheme, S4A scheme, SDR scheme, etc. That was a particular time frame where there were a plethora of schemes. None of them really worked. None of them emphasized on a time-bound resolution. And there were also issues in terms of ensuring that all creditors come together into a single mechanism and consortium of banks do not go in different directions. So with a view to overcome all these challenges, RBI initially issued a circular in 2018, which was on the same lines as the current June 7, 2019 circular, except one or two major differences, which I'll highlight. So one of the major difference between this old circular and the new circular was that under the old circular, there was a generic direction of the RBI that in case resolution is not achieved within the prescribed time frame, then automatically all cases had to be referred to IBC for resolution. This was found to be not in accordance with the constitutional principles and the principles of the Reserve Bank of India Act, especially Section 33A, under which the RBI derived the power to direct resolution under the IBC. And Supreme Court quashed that circular in 2019. So following that, they issued a new circular. And this is the new circular under which the resolution is currently governed. Now, in terms of timeline and classification also, there were a few changes. So what happens is that as soon as there is a default, the RBI circular requires that that default be recognized immediately. And banks are required to start classifying such an account as a special mention account. And as soon as that default has occurred, bank has to initiate discussions with the borrower to initiate resolution. Now, banks as well as the borrower get a 30-day review period where they can decide, what could be the potential resolution strategy. If they agree that a resolution is implementable and something that can be achieved, then bankers come together and execute an intercreditor agreement. So pursuant to this intercreditor agreement, it's kind of a committee of creditors, similar to the one that is there in case of IBC. So all lenders come together and work with the borrower to decide and execute on the resolution strategy. Any resolution plan that is put up for approval of the banks needs to be approved pursuant to the intercreditor agreement. And there is a provision that at least 75% should agree. And this percentage is slightly different than the RBI, than the percentage in the IBC, but that is how the RBI circular is there. And thereafter, once the 30-day review period is over and it is agreed that resolution can be implemented, then the 180-day resolution period starts, within which the resolution has to be implemented. Again, mind you, so this is kind of a proactive strategy in the sense that you do not wait for account to turn into NPA. Mind you, an account turns into NPA only after continuous default, or if the account remains in default for more than 90 days. So this is kind of a proactive strategy in which you try to resolve the insolvency or resolve the default at the earliest possible opportunity. So the reason I'm saying that this is a time-bound process is that if within 180-day period, if resolution plan is not implemented, then the circular contains an inbuilt mechanism of various incentives and disincentives. So what do I mean by this incentives, disincentives? So because the earlier circular, which directed mandatory reference to IBC, was found to be not in accordance with law, what this new circular does is asks bank to make additional provision if the resolution is not achieved within 180-day period, and if the resolution is achieved within 180-day period, then it is obviously fine, and the account can in due course can be regarded as a standard account. But and then that some of the additional provision can be reversed if subsequently reference to IBC is made. So this is the kind of mechanism or the incentive mechanism that is there for banks to ensure that resolution is achieved. And if resolution is not achieved, then cases are referred to IBC. I'll make one more point here, that it is not always mandatory to go through this resolution framework under the RBI framework. So for instance, if default occurs and banks and lenders together decide that the best mechanism in a particular situation is to make a reference to IBC because a potential buyer is not going to be found or there are some other issues, then the direct reference to IBC can be made. So this is not a mandatory resolution framework, but it kind of provides a window or an opportunity to achieve the resolution in a pre-IBC situation. Resolution plan per se can provide for a variety of steps and structuring mechanism. So there is no restriction as such under the RBI framework as to what one can and cannot do. I'll highlight some of the things which can be implemented. For example, there is ability to raise additional funding, interim funding by the corporate debtor within this RBI framework. If there are certain assets which can be sold and leased back, such a transaction is also possible within the framework of the RBI resolution. One can look at converting debt into equity and give equity stake to the banks. One can also restructure, i.e. modify the terms of payment or change the interest rate, gain some moratorium period so that servicing is not required to be done, immediately. Banks themselves can sell the exposure to other parties and other investors. And this is important because the lot of the activity around securitization market is kind of quite is there a lot because of this ability to sell the exposure within this framework. And last but not the least, one can also try and seek change of ownership, try and seek a new business partner, try and introduce a new business partner within this RBI framework. So almost all possible mechanisms that are conceivable are available, to be implemented under the RBI framework. Moving on to the next slide, please. So even when the resolution is not under statutory framework of IBC and it is still under the framework of RBI direction, still there is a lot of relief that is available under various laws and regulations. First and foremost, if the resolution plan envisages conversion of loan into equity, then banks have been provided a lot of exemptions so that they are able to acquire sufficient stake in the borrower. For such a conversion, SEBI's preferential issue guidelines do not apply. So, so for example, aspects such as pricing of the issue of the shares upon conversion, especially in case of a listed company, one does not need to follow 2 by 26 week mechanism under the SEBI preferential guidelines. If the book value is substantially lower than such 2 by 26 week average, then one can get the allotment of shares at book value. However, there are some safeguard mechanisms also, i.e. that the conversion price has to be, a valuation report has to be obtained in respect of the conversion price. There is lock-in also that is applicable of 1 year. However, what has been done is that, banks are permitted to transfer shares within that 1 year lock-in period. However, the acquirer of those shares will not be able to sell shares until the 1 year residual period of lock-in is complete. Further, there is also exemption from making an open offer under the SEBI's takeover code. This kind of deals where there is conversion of loan into equity and banks acquire stake, typically very sizable amount of stake is acquired by the banks. Which would cross this threshold under SEBI takeover code of 25%. So there is an exemption available there as well. Furthermore, there is an exemption under the Companies Act also for issuing such shares at a discount on conversion of debt into equity. So basically, various other laws also come together and facilitate the transaction where banks acquire some stake in the borrower. Very recently, in fact, the last week, SEBI has also issued a consultation paper for permitting listed entities to issue shares under the preferential issue guidelines without applying the pricing mechanism of 2 by 26 weeks. So what this consultation paper essentially does is permits the listed company to issue shares to any investor. Now this, again, this need not be restricted to banks. This preferential issue can be to any potential investor who might be interested in funding a particular stressed company. And one would have to only look at the 2-week average because, typically share price of such a company witnesses fall. And so looking at 26-week average, may give you a price which is not competitive at all in terms of raising funds. So, this flexibility is available. Further, there is also proposal to exempt such acquirers or such investors from making an open offer under the SEBI's takeover code. So if the recommendations in this consultation paper get implemented, that would facilitate fundraising by companies which are under stress. Lastly, but not the least, under the ECB regulations also, there are certain concessions available. Mainly to do with, ECB can be raised for repayment of INR rupee loan, which has been taken for capex in infra or manufacturing sector for the purpose of one-time settlement with banks. So what you could do is raise money abroad through ECB route mechanism, use the proceeds. As we all know, ECB regulations has end-use restrictions. So what this relaxation allows is that money raised under the ECB route can be utilized for funding one-time settlement with the banks, where the INR loan is used for capex. Banks are also permitted to assign their loans to eligible ECB lenders directly. So this also kind of broadens the market in terms of potential acquirers and investors for distressed loans outside of the IBC framework. We can move on to the next slide. Yeah, so that was broadly the RBI framework, whereas we saw there is a lot of flexibility available in terms of doing the resolution. Now let us quickly look at the IBC framework. So as we all know, India enacted bankruptcy code in 2016, and that is a reform of, that's a very, very significant reform, where India's insolvency regime, which was in doldrums, was completely transformed at a stroke of a very modern legislation. And one must commend the governmental authorities who have ensured that whatever the challenges that were being faced by participants in the insolvency market, be it banks, be it acquirers, be it resolution professionals, etc., they have continuously made changes to the law so that it remains relevant and facilitates insolvency resolution. So we have a very, very robust insolvency mechanism, as I would put it, and which is comparable to any best in any of the other resolution mechanisms around the world. So broadly, the insolvency resolution mechanism under the IBC. So this is a single insolvency resolution framework. Insolvency resolution of companies, individuals, partnership firms, of all other is covered within this single code. Of course, the provisions with respect to partnership firms and individuals have not been made effective as yet, except in case of personal guarantees. So to that extent, code is not operational. And through an amendment in December by virtue of an ordinance, IBC mechanism has also been made available to financial services providers. And currently it is applicable to NBFCs with asset base of more than 500 crores. So this is important because without this change, DHFL's resolution could not have been pursued under the IBC mechanism, which gives a lot of advantages. And so that change is quite important. The code emphasizes on a time-bound resolution. We will shortly see in one of the following slides, how exactly the timeline works. But the emphasis is there to complete the resolution as early as possible so that the value of the assets does not deteriorate significantly during the insolvency process. There is a timeline of 180 days, which can be extended by another 90 days. But overall resolution has to be completed within 330 days. So there is a lot of emphasis in ensuring time-bound resolution process. The IBC resolution process can be initiated only once the default occurs. So this is important. Because this emphasizes on a cash flow based approach. The earlier mechanisms such as SICA, BIFR, emphasized on a balance sheet based approach, i.e. they would look at what is the overall net worth, what is the erosion of the net worth, look at those aspects for some of those mechanisms to be made available. Here emphasis is not on balance sheet at all. As soon as one has not met its obligation to any of its creditors, be it operational or financial creditors, and a default occurs, the IBC process can be triggered. And as we know, just last month, the threshold has been raised from 1 lakh to 1 crore. So this is helpful. And especially to ensure that small matters do not land up at the door of NCLT, under the IBC framework, which is meant really for resolution of a severe stress situations. Another important aspect of the IBC framework is that it allows lenders to come together to control the borrower. So this is a creditor in control regime where the existing board of the company is suspended and the entire management is and sort of control rests with the resolution professional and the COC. and all significant decisions require COC's approval. So this ensures that creditors whose interest is the most in terms of ensuring resolution, their interests are protected because they are under the control of the resolution framework. Another important aspect, and this is where there will be differences between an out-of-court process such as RBI framework versus IBC, because IBC provides you advantages in terms of moratorium also. So as soon as the application is admitted for resolution, the moratorium is imposed. This essentially means that lenders cannot proceed against the company for recovery of any money or any other creditors, be it operational, government creditors, statutory dues. None of that can be recovered and enforced. So, it gives the company breathing time so that it can stabilize and the resolution process can be completed. IBC code also has a very clear priority of distribution. It ranks the dues of the financial creditors, especially the secured financial creditors, have superior priority over all other dues, and especially government dues rank equal to operational creditors' dues. So, this ensures that lenders who have lent large sums of money, are given the first chance to be able to recover in case of a resolution. We can move on to the next slide, please. Yeah, so here on this slide, what I have tried to do is kind of briefly summarize the resolution process. So the process starts with a claim. So basically, any operational or a financial creditor has to have a claim or a due which is payable to them. If there is any failure with respect to payment of such claim, then a default arises. And as soon as a default arises, an application can be made to the NCLT for initiation of resolution process. This application can be filed by financial creditors if there is a default with respect to any dues to such financial creditor. It can also be initiated by operational creditors, and corporate debtor himself also can initiate the resolution process. Then once the application is filed, there is a period of 14 days within which NCLT has to either admit or reject the application. And once the NCLT admits the application, moratorium is immediately imposed and the resolution process commences. Ashita, if we can just click, do some more clicks, so more process will come up. Yeah. So then, once the moratorium is, once the NCLT admits the application, a resolution professional is appointed. At this point, the board of directors of the erstwhile management is kind of suspended, and board's duties are suspended, and the entire administration of the corporate debtor vests in the resolution professional. Resolution professional would invite, all creditors to lodge their claims. And once the claims are lodged, the committee of creditors will be formed and the voting shares will be allocated based on the amount of debt that is outstanding. Mind you, this COC consists only of financial creditors. Operational creditors do not form part of the COC. They have a role to play only when there are no financial creditors at all. But in case of a stressed asset situation, that is unlikely that they don't have any financial creditors. Then resolution professional invites various players to submit their resolution plans. And then this resolution plans are considered by the COC, and whichever is the highest bidder, so to say, that plan can be approved and 66% of the financial creditors need to consent to it. And then the plan is submitted to NCLT for its approval. So this is broadly the process so far as resolution under IBC is concerned. As I mentioned earlier, there is a time limit of 180 days. This can be extended by another 90 days with the approval of committee of creditors. And then through a recent amendment, what government has tried to do is to impose an overall time limit of 330 days, including litigation. Now, there was a lot of this came up before the Supreme Court. Validity of this 330-day timeline came up for discussion in Supreme Court's decision in case of SR, where the court held that this 330 days time limit cannot bind the courts themselves. It binds the resolution applicant and other players, but it does not bind the court, court or the NCLT. What does it mean is that if the delay is attributable solely because of slow process at NCLT, then NCLT is at liberty to extend that time limit further. But the emphasis is still on achieving resolution within the overall time limit of 330 days. We can move on to the next slide, please. Right. So let us now briefly understand that what a resolution process or what the resolution plan under IBC would envisage. So resolution plan under the IBC has to be for resolution of the corporate debtor as a going concern through amendment into the law as well as the relevant underlying regulations. It has been made now abundantly clear that corporate restructurings such as merger, demerger, slump sale, all of that can be achieved through the process of resolution plan and its approval. The beauty of IBC process is that once the resolution plan incorporates this restructuring such as merger, demerger, slump sale, etc., there is no need for a separate process. So once resolution plan is approved, such mergers, demergers, etc. are also approved. And we'll see that there are some reliefs also in this connection which are available in the other laws shortly. Resolution plan should not contravene provisions of other laws. Now, this is important. While IBC itself overrides all other laws, but resolution plan is not supposed to contravene the provisions of the other laws. This is mainly to strike that balance where there are procedures that need to be accomplished under other laws, or where other laws impose certain obligations, then those obligations are not given a go by through the process of resolution mechanism. So that is the overall objective behind this provision. Resolution plan, once it is approved, it is binding on all stakeholders, including government authorities, local authorities, statutory authorities. One cannot, once a resolution plan is approved, a governmental authority cannot come back and say that, see, certain amount of dues is still payable to me, and I will disregard the resolution plan. So that's quite important. Again, the resolution plan provisions kind of enforce this overarching principle of the IBC that financial creditors have superior right. This is through certain provisions under the IBC code, which require that a committee of creditors have a free hand in deciding how the resolution proceeds are distributed, and they can decide that based on their commercial judgment, and court has a very limited jurisdiction to interfere so far as those commercial decisions are concerned. Under the resolution plan, operational creditors are entitled to a minimum of only liquidation value, or the amount that is distributed that becomes entitled to them as per the waterfall mechanism under section 53 of the IBC code, which we will see very shortly. Now, this is important, and financial creditors, especially the secured financial creditors, have a priority right. And generally, the resolution proceeds is not even sufficient to fully discharge the dues of the financial creditor. So where is the question of making any payment to operational creditor, right? Who has, who has certain dues which are completely unsecured. So resolution plan mechanism sort of reinforces this provision. We can move on to the next slide, please. Yes, so here is the waterfall mechanism which I was referring to. This waterfall mechanism finds, you will find it in the IBC code within the liquidation provision. But this waterfall mechanism is equally applicable and relevant, in case of resolution, which, under the CIP process. This is because, as I mentioned, some of the provisions around operational creditors, where the minimum amount that is due to them is decided based on this waterfall mechanism. And financial creditors, in deciding how the amount has to be distributed, can take the recourse to the waterfall mechanism in order to ensure that the overall purpose of the IBC is achieved, and that the proceeds of the resolution are distributed as per this mechanism. So as you would see here, the highest priority is of the insolvency resolution process costs. Then we have secured creditors in the waterfall mechanism, if their security is relinquished, and workmen's due. So basically workmen's dues for 2 years have also been given status equal to that of the creditor, or that of secured creditors, to ensure that the genuine workers do not suffer because of the insolvency. Then we have financial debts to other unsecured creditors, and after financial debts, we have government dues. So they rank far below in terms of the secured financial creditors in the waterfall mechanism. And then we have other debts, preference shareholders, and lastly the equity shareholders, who typically because the liquidation value is typically zero, they are not typically entitled to any amount under the resolution framework. We can move to the next slide, please. Yes. So sorry, one slide before. Yeah, thank you. So now let us briefly discuss some of the relaxations that are available under the other statutory provisions. So as I mentioned, the provision with respect to issue of shares at discount, this is a benefit that we discussed. This is available also in case of resolution outside IBC framework under the RBI regulation. So this benefit is available even in case of an IBC framework. Again, there is a general circular issued by the MCA, which specifically states that once the resolution plan has been approved by the NCLT, there is no need for separate approval of shareholders and other stakeholders. As we saw earlier, the ECB relaxation for repayment of INR term loans is available even in case of an IBC. So basically, a potential investor can raise ECB funding and utilize it to pay the lenders under the IBC resolution process. This is a permissible end use under the ECB regulation. And then there are several exemptions which are available under the SEBI regulations, primarily to deal with delisting of shares, exemption under the preferential issue guidelines for issue of shares, and exemption under takeover code. Let's just spend time on the SEBI aspects. Companies Act and ECB we have seen earlier also, but let's spend time and discuss some of the relaxations that are available under the SEBI regulations. So first and foremost is the relaxation under delisting regulations. So, a potential acquirer, when he is investing huge sums of money in acquiring a company under the IBC, would want to, sorry, we can stick on the previous slides. Yeah. Would want to ensure that he gets full autonomy and freedom to restructure the business, and is not under pressure of other public shareholders, etc., and comply with or the compliance that are applicable typically to a listed company. And so that's why this relaxation has been given under the SEBI rules to permit delisting. So basically, what the provision says is that so long as a resolution plan sets out the procedure of delisting, then delisting will be valid as per that procedure which is approved under the resolution plan. And so far as payment to the public shareholder, exit option to the public shareholder is concerned, what the flexibility that we have is that exit price has to be at least equal to the liquidation value of shareholders. So, you do not have to do the reverse book building, etc., which is typically required under the delisting regulations to arrive at the delisting price. And the minimum price that is required to be paid under the regulation is the liquidation value. And as we have seen in several cases, liquidation value tends to be zero. So it is okay if public shareholders are not paid any amount on their exit from the listed company upon delisting. So this is a quite generous and a liberal regulation facilitating resolution under the IBC framework. Now let's look at the preferential guidelines. So it is very often large sums of money would need to be raised and infused, and the infusion would also be required in the form of equity. So here we have exemption under the preferential regulation, where the pricing guidelines, the rules around shareholders' approval, tenure, etc., are not applicable under the preferential issue guidelines. There is a lock-in provision which applies in respect of the shares, further under the takeover code also there is an exemption to not make an open offer, and it is also permissible for minimum public shareholding. However, if as a result of the resolution or under the resolution plan, one ends up acquiring greater than 75%, then over a period of 1 year, the stake has to be brought down at least to 85%. And then over a period of 3 years, it has to be brought down to 75%. So quite a generous regulatory regime that we have here in case of resolution or acquisition of companies under the IBC framework. Now we can move on to the next slide, please. Right, so that was a broad overview in relation to the resolution and the statutory and regulatory mechanism that is available under the IBC and outside of IBC. As we saw, there are several advantages of pursuing resolution under IBC. And, from the perspective of an acquirer, there are several advantages. And, the biggest among them is that one can start the company with a clean, one can acquire the company with a clean slate, so to say, where all past liabilities, obligation, stand waived on approval of the resolution plan. So now, we can turn our attention to certain tax and structuring issues, in connection with the resolution under IBC as well as outside of IBC. A lot of tax issues are common. And while there are certain benefits that are available even under the taxing statutes for resolution under the IBC, we'll look at those as well and compare, how do they relate to each other. So the first and the foremost issue that one will come across in each and every resolution, whether under IBC framework or outside of IBC, is the tax treatment of write back of debt. So, and again, this issue is further, if to further dissect this issue, how one would look at term loan, which are typically used for capital expenditure, and how one would look at working capital loan, which kind of revolves in the business, and sort of gets reflected in terms of the trading balances on the asset side. How tax treatment of this would work. So, from a write back of loan perspective, we have Supreme Court's decision in case of Mahindra and Mahindra's case, where Supreme Court held that write back of loan should be regarded as a capital receipt and should not get taxed under 41(1) or 28(4) of the Income Tax Act. But there are still issues that whether can taxability arise, say under 28(1). And while there are arguments that this is not really a business or a trading receipt, but those issues require careful deliberation, and this is where structuring some of this transaction becomes quite important, and we'll see some of those structures shortly in some of the case studies. Another aspect is that write back of outstanding interest. Now, typically in an IBC situation, what happens is that the interest is not serviced. And if interest is not serviced, it is very likely that deduction in respect of this interest would not have been available, especially where the borrowing is from banks. Now I understand this provision is also extended to NBFCs, but considering the historical situation, typically one would have not got the deduction under section 43B because of non-payment, and therefore potentially write back of outstanding interest per se should not create tax issues. However, write back of operational creditors, there is no doubt such write back of operational creditors should be taxable, and therefore it becomes very important that whether this write back is going to lead to any cash tax outflow in a given situation, and what are the brought forward losses that are available, ability to set off those losses and continue those losses as part of the restructuring becomes quite important. Often in case of restructuring, we find that the asset side of the balance sheet is typically bloated, in the sense that there are assets which are stated on the balance sheets which are overvalued. Inventory may not have been correctly valued. There may be some stock which is not valuable at all, and therefore there is a genuine case in terms of writing off some of those assets. Now, how this write-off of assets would be looked at from a tax perspective, that is important. In case of depreciable assets, I don't think, in my view, there should not be any deduction available just merely on write-off, unless there is an actual transfer and that and the block ceases to exist. Then there could arise a capital loss situation, which may be permissible. But otherwise, depreciation, so long as the block does not cease to exist, the depreciation should continue to be available. So far as non-depreciable assets are concerned, if they are actually written off, then this deduction in respect of the same should be available as a business loss. But if you merely make a provision for impairment, then deduction for such a provision should typically be not available. Another issue in terms of restructuring or in an IBC or a resolution framework is conversion of debt into equity. And here, there could be conversion of outstanding interest as well. So one question that arises is that when outstanding interest is converted into equity, should a deduction with respect to the same should be available or not? Ordinarily, upon conversion of debt into equity, the interest should be considered to have been discharged, and therefore deduction should ideally be available. But sometimes fact pattern becomes quite interesting, especially in an IBC situation where immediately after conversion of the outstanding interest into equity, if such shares are reduced under a capital reduction process, given that the sustainable amount of debt is significantly lower, then a question would arise whether in such a situation where shares are immediately reduced under a capital reduction process, should a deduction be available or not? So apart from this normal tax issues, there are several issues that arise from a MAT perspective also. So write back of, especially under Ind AS, write back of liabilities, would be required to be credited to P&L. Any gain arising on write back of liabilities would need to be credited to profit and loss account. And therefore a question arises, whether a MAT liability would arise or not in such situation, and whether any structures can be adopted to mitigate such a liability, or can we do the transaction in a particular manner, to mitigate that issue. And simultaneously, you could also have, as I mentioned, you could also have write-off of a lot of assets. So it ordinarily, it should, one should offset the other, and you should not have a MAT issue. One would also make impairment provision, but deduction for merely a provision may not be permissible for the purposes of MAT, and it may be required to be added back. Because it may get considered as diminution, as provision for diminution in value of assets, which is one of the adjustment for MAT purposes. And then the debt, if let's say outside of IBC mechanism, there is restructure of debt, and one would have to do a fair valuation, of such a debt. And therefore, there is a credit that arises to in the P&L account. Such fair valuation related gains would also become taxable for MAT purposes in the absence of any exemption. Debt to equity conversion, again from a MAT perspective, is quite interesting, because Ind AS requires that when debt to equity conversion happens, that one do a valuation of the shares issued. And if there is any gap in terms of the value of shares issued versus the liability that is extinguished, then difference again needs to be taken to profit and loss account and credited there. So again, all of these issues are likely to create a lot of taxable items from a MAT perspective. Ashita, if you just click 1 or 2 times, there will some other pop-ups will come up. Yes. So a lot of points that I mentioned around MAT might get mitigated, especially if the target is under the new regime, where MAT is not applicable at all. So this also becomes an important consideration, and especially, where you do not have sufficient amount of assets to write off, or you have a significant amount of gain. So it would be very interesting, that gets credited to PN. It would be very interesting whether the target is now under the existing regime or the new regime. And if it is possible to elect into the new regime, it could be a very nice way to mitigate the MAT implications, especially in situations where the resolution is happening outside of IBC, where the ability to set off losses under MAT provision is also very restricted, because one has to look at the lower of book loss and unabsorbed depreciation. So this is kind of a one good, this could be one good mitigant and an avenue available within the framework of the law to mitigate the tax implication and in terms of the structuring of a transaction. If we can move to the next slide, please. Yeah, if you can just do one more click. Perfect. So, well, apart from those issues which I just discussed, there are several other issues, that one needs to consider while structuring from the perspective of IBC or even outside of IBC. Some of the other issues that are quite relevant are, your ability to preserve the tax attributes. Or availability of these attributes to mitigate any tax consequence that might arise. So, take for example, operational creditors. As I mentioned, their write back is taxable. And however, if you have past losses available, then the cash tax impact may get mitigated with respect to such write back of operational creditors. Again, if there are MAT losses, then under the IBC framework you get a sum of unabsorbed depreciation and business loss. So depending upon the quantum of such losses available, it may be very important to see to what extent such brought forward losses mitigate any MAT related issues or any MAT related tax liability that may arise as a result of restructuring. Again, tax holiday, let's say if the target has a unit which is eligible for ATIA deduction, then it once again becomes very important to carefully consider that whatever restructuring steps that might be envisaged under the resolution plan, whether they enable for the tax holiday to continue, for the tax holiday period to continue even post restructuring. So as we all know, under ATIA on mergers or demergers, the tax holiday is now lost. So it is very important to carrying steps, to ensure that the benefit is not lost, and one may have to look at achieving the intended restructuring through some other manner, such as slump sale. Another massive issue, and which kind of remains completely unresolved, is the issue of deemed gift tax. So here, by deemed gift tax, I essentially mean provisions of section 56.210 and 56.2.7b. It is quite ordinary to expect that any restructuring, whether under IBC or outside IBC, would involve large amount of fund infusion by way of shares and securities, and involve issue of shares upon conversion of debt, or write back of creditors and loans. So a question arises whether on any of this transaction should a tax liability trigger under this deemed gift tax provision. Typically in a IBC situation, especially take for example listed companies, the share price of the listed company, which is the benchmark for valuation under 56.210, may not reflect the price at which share infusion is viable. We very recently saw cash infusion in case of Yes Bank, where the infusion took place at a significantly lower price than the ruling market price. And the issue arises that if in case of such a transaction in the hands of the subscriber of such shares, whether any tax liability would arise under 56.210 or not. And commercially, it may be completely unviable to infuse money into the target at the ruling price. So therefore, this is a massive challenge that one faces while dealing with a listed company and an issue of 56.210. This may not be a very big issue in case of unlisted companies, where the valuation mechanism, especially for equity shares, is book value, where it is likely that book value is likely to be negative, especially if there are a lot of accumulated losses, etc. And if the book value is negative, and even if you subscribe at face value, can someone say that you have received benefit in that sense because the book value is negative or zero? So this remains as an unresolved mystery. I would point out here that there is a provision in section 56.210 which empowers the government to notify certain transactions which will be considered as not liable for the purpose of 56.210. It is very important that IBC related cases and restructuring related cases are specifically exempted. As there are several exemptions which are available under those provisions. Again, another issue that arises is that can write back of loans or creditors, can that trigger 56.210 liability? The issue being that, when the lender had originally lent, he would have given you money. And now, pursuant to the resolution plan, you are no longer required to pay the same amount of money back. And therefore, is it like a gift that one has received? Again, there are technical arguments that 56 to 10 should not apply in such situation. The primary and the most important argument being that when originally I had received money, it was in a different year, and now the resolution is happening in a different year. Write back is already, if the government wanted to tax it, it could have made amendment under business profession chapter. And between the dichotomy of which income and under which head to tax such income, basically the business and profession head, which is a specific head, should prevail. So these arguments are available, but one never plans or structures a transaction with a litigation exposure. So again, to facilitate insolvency resolution and to facilitate restructuring of distressed assets, it would be highly recommended to, if government could notify this as well as one of the exempt transactions. Lastly, but not least, as I mentioned, there are variety of differences between structuring a transaction under IBC and outside IBC. There are several reliefs which are available only in case of IBC. If the resolution is under IBC and they are not available outside of IBC. Primarily, the reliefs are that, under IBC, if there are any outstanding tax dues as part of the resolution process, if operational creditors are not entitled to receive any amount under the resolution plan, then such tax dues should stand waived. Furthermore, so far as MAT is concerned, instead of the lower of UAD or MAT, one can get a deduction for sum of UAD and MAT. Sorry, sum of business loss and UAD. And there is also ability to continue to ensure continuity of tax losses, especially where there is a change of control, where the significant amount of stake is being acquired by the acquirer, and the company is not a widely held company. In such a situation, this relief become of very vital importance. One key aspect is that there is a provision in section 79 to give Commissioner of Income Tax an opportunity of being heard. So it is very important that in the IBC process, it is kept in mind that the appropriate notices are duly issued and an opportunity of hearing is afforded to the Commissioner to ensure that any claim of continuity of losses does not become invalid. Lastly, I highlight this issue around GAR. So, as we all know, we have anti-avoidance rules which are effective and operative, in the as of today, and therefore, in any transaction or structuring that we propose in case of resolution or debt resolution under IBC or even outside IBC, it is very important to ensure that no steps are being taken just with a view to obtain tax benefit, because such steps or transaction may get challenged under the provisions of GAR. So it is very important to ensure that your transaction has adequate commercial rationale and backing so as to ensure that that GAR is not applicable. We can move on to the next slide, please. Yes, so apart from tax issues, there are certain other factors also to consider and keep in mind. So one of this issue is, for example, stamp duty, which can be an actual cost. So as I mentioned, that provisions, just because the resolution is happening under IBC, the provisions of other law does not become inapplicable. They continue to apply. So therefore, whatever steps that are being undertaken as part of the resolution plan and mechanism, if there is any stamp duty applicable, then it will have to be discharged based on the stamp law of the relevant state. And this also should be kept in mind and considered. If there are, if the structure envisages creation of SPVs, etc., one also has to consider and keep in mind that whether those SPVs require registration with RBI as NBFC or CIC, how the 50-50 asset and income criteria is whether such income and asset criteria is applicable in the case of your given SPV, and if so, if it is applicable, then quite important that those registrations are obtained if necessary. Again, FEMA also becomes very important, especially in a situation where we are dealing with a non-resident acquirer. If such a non-resident acquirer forms any SPV or any other BidCo in India, then how the provisions, especially relating to foreign-owned and controlled company, become applicable. Whether any government approval will be required or not with respect to such an SPV vehicle, because one of the activities that such a vehicle might do may be investment-related activity, and so therefore, whether a prior government approval is required or not. Some of these issues need consideration. If it is an FOCC, again, then we'll have to ensure that valuation parameters and other entry route and other conditionalities that are applicable in case of an FOCC are duly considered, and if there are and those regulations are duly complied with. Further, competition law provisions also need to be considered. So if there is an acquisition where the where the merger filing is getting triggered under the provisions of competition law, it is such filings will have to be carried out, and prior approval of the Competition Commission will have to be obtained depending upon the threshold revenue and other thresholds which are applicable as per the provisions of the competition law. We can move on to the next slide, please. Right. So as we saw, there are variety of issues and considerations that go in terms of structuring a transaction. Yeah. In terms of structuring a transaction under IBC or structuring a resolution outside of IBC. So what I've done is created a few case studies that we can discuss and deliberate, and how typically the situations look. So I've chosen two case studies which deal with structures where resolution is happening outside of IBC, and two case studies where the resolution is happening under the framework of IBC. So let's go through these. So case study one is a case study where this is a case of a one-time settlement. So we have a borrower company which has taken a loan from bank, say for example, and the borrower company has defaulted, and under the resolution it is agreed that the debt will be settled, say at 50 paise, and the bank is okay to recover 50% of the outstanding and waive the balance 50%. So typically, in terms of mechanics, such a borrower company would have to raise funding. It could come from the promoter group if the promoter has liquidity available. Then funding could come from the promoter group as well. Or if the funding is not available from promoter group, or a combination of investor and promoter funding could also be there. Again, in terms of funding, there will be a variety of consideration that will go into whether it should be equity funding or it should be debt funding. Investor would always want piece of the slice, in the sense that if this company revives and does well, then he would typically also want return his return to be sort of equity like. So how does one structure around it? So those kind of become quite important criteria. So there would be raising of funding at the borrower company level. Borrower company would pay the OTS consideration to lender, and there we'll have OTS and the resolution of the insolvency of the borrower company. Some of the key issues that become relevant to consider are, some of this we already discussed. So one of the key issue here will be that if there is any gain on the write back of debt, whether such OTS gain will be taxable or not. As we discussed, we have the benefit of Supreme Court's decision in case of Mahindra and Mahindra. However, we also saw that there could be issues around 56 to 10 in respect of such a write back gain. Or, apart from that, in terms of issue of shares, let's say promoter is putting the money by way of equity, then at what price or valuation such infusion should take place. One would have to carefully consider what is the 11 UA value of such equity shares. If such value is zero or negative, then unlikely that there will be a challenge under 56 to 10. However, what about 56 to 7B, where if the amount has come in with a premium, then can such premium be regarded as taxable in the hands of the company? However, one important benefit is that in case of 56 to 7B, we do have some flexibility in terms of valuation, where a DCF valuation can also be undertaken. So, that flexibility is quite helpful. But again, some of these issues around deemed gift tax, right of liabilities, etc., become quite crucial. From the perspective of investors, one would have to look at that, how should one structure the fund infusion, especially if it is funding from a foreign investor, whether there are any benefits in terms of lower withholding tax that might be available. So for example, we have a lower withholding tax regime that is available for foreign currency denominated debt, as well as lower tax regime for FPIs. Whether can investors structure into some of those regimes under the Income Tax Act to be able to gain benefit of lower withholding tax, would be one of the crucial consideration here in this case too. So the issues are structuring of fund infusion from investor and promoter perspective, and the mitigation of certain tax liabilities that might arise to the company itself. Again, when it comes to MAT, the issue of new versus old regime will also be equally relevant here. Because this resolution is outside of IBC, the entity may not have ability to set off some of UAD and business losses. So if there is any, the write back will definitely result into gain that will get credited into the P&L. So how does one mitigate that? That also becomes quite crucial. And if it is possible to elect into the new regime, then that could be one of the ways to mitigate the MAT implication. We can move to the next case study, please. Yeah. So this case study, here we discuss the ARC structure. Basically, and this is quite a popular structure. That's why I thought we should definitely put this and kind of put it on the table to discuss. ARCs are basically governed by SURFACE Act. And RBI is the regulator of the asset reconstruction company. All of us would remember ARCL was the first ARC, and thereafter, since the FDI is liberalized in ARC, we have a plethora of ARC which are operating in the country currently. And this structure is quite helpful. So let me just briefly explain how the structure typically works. So again, we are looking at a situation where the borrower wants to do a one-time settlement, and the funding is supposed to come through investors and ARC. So what can happen is that the ARC and investors would contribute to a securitization trust, and such a securitization trust would use that funding to acquire loan from lenders, say at a haircut. And then therefore there is a payment of OTS consideration from securitization trust to the lenders, and as a result of which, with respect to the borrower company, the lender is no longer the original lender, but the securitization trust. So kind of lender-borrower relationship then gets established between securitization trust and borrower company, as lenders will assign the debt to the securitization trust, and thereafter, future servicing of the debt by the borrowing company would happen to securitization trust. Now, so it's quite similar to the earlier structure, but there are some differences. There are some structural differences as well as certain tax differences. First and foremost, securitization trust enjoy a complete tax pass-through regime under Section 115 TCA. And there are other benefits as well, such as, for example, borrower company does not have to deduct any TDS on any payment that is made to securitization trust. Securitization trust itself is exempt in respect of its income. Investors and ARC will get taxed in a same and like manner. And this is unlike AIFs or REITs and WEITs, which enjoy limited pass-through. Securitization trust enjoys complete pass-through. So on all types of income, only investor is taxable in a same and like manner capacity. Securitization trust has to withhold taxes on any payments that it makes to ARC and the investors. So TDS is required to be done. But the ultimate tax liability is in the hands of the investors only. So it's quite an attractive structure, and especially foreign investors, especially FPI investors, are permitted under the FPI, SEBI-FPI regulations and relevant FEMA regulation to subscribe to security receipts issued by the securitization trust. They get they can claim treaty benefits as well. So it is quite an attractive structure. From the borrowing company's perspective, unlike an OTS that we saw in the first case study, it may so happen that there may not be immediate write back, and the borrower company will have to work out or work with the investors to sort of kind of ascertain how the debt itself will be restructured. So let's say merely on assignment of debt from lender to securitization trust, the liability of borrowing company does not undergo any change. So at that stage per se, there is no tax liability trigger in the hands of the borrowing company. However, investors and borrowing company may undertake certain restructuring of the debt itself, and that would create same issues as we discussed in the earlier slide with respect to the borrowing company around write back of loan and liability, etc. So this is a quite attractive structure and quite popular, and it's getting deployed in variety of cases. We can move on to the next slide, please. Right. So here is a structure which is a structure for acquiring a company under the IBC, and this is a capital reduction structure that I've highlighted here. So the mechanics is quite simple. The acquirer incorporates an SPV, which is infused with say debt equity. SPV in turn infuses debt or equity into the target under the resolution plan, and resolution plan envisages conversion of unsustainable debt of the target company into equity shares, and thereafter capital reduction and consolidation, and sustainable debt is repaid. So so this is a structure which was actually deployed, a variant, or may I say a variant of this structure was actually deployed in case of Vedanta's acquisition of Electro Steel. And this structure has a lot of advantages in the sense that, when capital reduction happens, that is, so let's say when the debt is converted into equity shares, at that point, there should not be any normal tax liability. So long as the equity shares are issued equal to the amount of the debt. Furthermore, capital reduction per se is a transaction which gives rise to capital receipt. So again, there may not arise any tax liability at that stage. However, from a MAT perspective, this structure may have certain issues. So under Ind AS especially, when shares are issued in consideration or in discharge of the loan, one needs to consider that what is the value of the shares. And as I sort of kind of mentioned earlier also, if there is any gap between the value of shares issued versus the amount of debt extinguished, then the difference is required to be credited to profit and loss account. There are some exceptions where under accounting rules from this credit, especially where the loan had an inbuilt mechanism for conversion, and the conversion happened through a shareholder right kind of situation, then in such a case, one may be able to take an exemption under the relevant Ind AS provision. But in most cases, we have seen that auditors come back and say that, in this situation, we will have to credit the difference to the profit and loss account. And then, a question of MAT liability arises. Now, one of the mitigants could be that because this is processed under IBC and you have some of UAD and business loss available as a deduction, that itself might mitigate, along with write-off of overvalued assets, might mitigate the negative impact. But it may not be sufficient, and therefore MAT tax liability will be a consideration. And now that we have the benefit of new regime, concessional tax regime, the interplay of election into new regime will also be an important factor. Especially in a structure like this, where MAT liability may be the key consideration. Next case study, please. Right. Yeah. So again, this case study again is a structure for acquisition under again a structure which we have seen being deployed in the past. This structure involves assignment of debt and then merger. So this structure was used in Tata Steel's acquisition of Bhushan Steel. So what this structure essentially envisages is that the acquirer incorporates an SPV. As part of the resolution plan, the entire debt of the lenders is assigned to this SPV for consideration equal to the sustainable debt payment under the resolution plan, or equal to the resolution proceeds. And once this assignment has taken place, there is a merger of SPV into the target. So what happens is that upon this merger of SPV into the target, the loan asset and loan liability are cancelled. And because it is cancellation upon merger, asset liability both getting extinguished, again, there should not be any impact from the perspective of taxability of write back of debt. Furthermore, another advantage of this structure is that acquirer will acquire the shares in the target through the mechanism of merger. So that is helpful, because from the purpose of deemed gift tax, i.e. 56(2)(10), we have an exemption for acquisition pursuant to the merger. So becomes quite an attractive structure. However, again, I come back to the same point, that one will have to thoroughly consider that whatever structure that one is adopting for acquisition under IBC, or any kind of restructuring outside of IBC as well, that whether some commercial purpose is being achieved or not, and if the mechanics are purely with a view to avoid tax liability, or then question of GAR would come up, and one would have to carefully consider whether such a transaction can be disregarded. So there is no immunity under the IBC from income tax liability arising on the transaction itself. You may have immunity with respect to past dues, but if tax liability arises on the transaction itself, there is no immunity for such a tax liability. So therefore, tax aspects of restructuring become very, very relevant and very important. We can move to the next slide, please. So yeah, I would kind of, so I've sort of set out here some concluding thoughts. So, it is abundantly clear to all of us, and I did not highlight this again, that several businesses in a variety of sectors are likely to undergo restructuring or resolution due to COVID-19 related stress. So the entire gamut of issues and the structuring mechanism that I highlight, that we just went through, is very, very relevant in the current times. The issue of IBC or outside of IBC is a very important issue, and very relevant in terms of consideration for both promoters, investors, banks, etc. Sometimes it may be possible to achieve resolution in a very speedy manner compared to the time that even IBC process takes when you do it outside of IBC. Another important aspect is, fear of losing valuable assets. See, we have seen several cases, SR Steel, where they lost control of their steel business and it transferred to ArcelorMittal. We saw several other situations where promoters have lost some of the very valuable assets because of the IBC process. So promoters will always have that fear, and therefore, their priority would be to ensure that they do not lose control of these valuable assets, and they would try to restructure outside of IBC if possible. So that also becomes a quite important factor in determination of IBC versus outside of IBC. To ensure, now, as I mentioned, we have seen a lot of regulatory changes in the IBC regime. However, there is still some scope to facilitate the process, and this I think is through the introduction of pre-packed insolvency regime. So this is a very famous regime in United States, where one is able to agree the entire restructuring plan with investors, bankers, lenders, other creditors outside of IBC or outside of the formal court process, and then one takes that entire pre-packaged resolution plan to the court for its seal of approval. Now, obviously, currently we do not have such a mechanism available in India, but if such a mechanism were to be introduced, it would be very, very beneficial, because as we saw, IBC process has a lot of benefits. You did not negotiate with each individual lender separately. All can come together under a single forum, and therefore the idea of pre-packed insolvency regime becomes quite important and will be very valuable. And finally, as all of us know, Companies Act, even 1956 Act and 2013 Act, has a provision for scheme of arrangement with creditors. In section 230, it is very much possible under the Companies Act 2013. But practically, we have never seen, or at least I have never seen, a scheme of arrangement being, or those provisions under the Companies Act being utilized to facilitate financial restructuring or restructuring with lenders and creditors. It is very, very important to strengthen that provision. Maybe it is not getting utilized because there is no under that provision. But provision or mechanism is strengthened, say for example by introducing moratorium. Again, it could facilitate the resolution overall. Because see, I'll highlight one issue and why this is important. A company or a corporate may have a variety of lenders. the RBI framework that we just saw dealing with resolution outside of IBC is not applicable to all types of lenders. It is applicable to banks, NBFCs, and other term institutional lenders or financial institution. But say, what if a company has borrowed from a mutual fund through CPs or through issue of NCDs? What if the company has NCD which are issued to a large set of investors like FPIs, retail investors, etc.? A resolution covering all of those creditors is not possible under RBI framework. Inter-creditor agreement has to be entered into only with those creditors to which that mechanism applies. So a question, from a perspective of the corporate debtor, the issue will always remain that how do you deal with other lenders and other creditors? So, it is very, such a promoter or credit or investor may be in a position to resolve, but he may not, he may not want to go into IBC. So therefore, the scheme of arrangement provision of the Companies Act are quite important in that sense. And suggestion would be to strengthen them further so that those provisions can be used to facilitate the insolvency resolution at large. So yeah, these are some of the thoughts that I had. And, in terms of the restructuring and issues under IBC, tax and other regulatory issues, I'm sure I may not have been able to cover each and every issue and each and every issue in great depth. But the idea was that I give in this limited time frame, I give you an overall overview so that, we are prepared to deal with this kind of situation if we were to face in our clients or, so that we remain prepared. So with that, I'll be happy to take a question. We have, I think, about 20 minutes still left. So I'll be happy to take questions and sort of, and make it as interactive as possible and gain and hear insights and experiences of others as well who are here in this webinar.
Thanks, Kushal. So can we head to the question and answer? Hello.
Yeah, Rajbhai, I think there are questions in the chat box. If we can take them up first.
Okay. So
yeah, I can also see them. So if
great.
I can also take them sequentially.
Great. Please go ahead.
Yeah. So first question is from Raghav. He's asking how to handle statutory debt under RBI framework. Can you also update on standstill clause? Okay. So yes, as I mentioned, you cannot deal with statutory debt under RBI framework. There is the inter-creditor agreement that is entered into is only with respect to the kind of lenders that I just mentioned a few minutes ago. So statutory dues would continue as it is, and those liabilities will continue as it is, and there is no way that you can deal with them under the RBI framework. So this is a disadvantage of going through RBI framework, especially where quantum of such liabilities is huge, and it's going to be significant in terms of overall resolution. And then the next question is, can you also update on standstill clause? I'm not clear. What do you mean by standstill? Would you like to, is it to do with moratorium? If Raghav is still there, maybe he can clarify that.
The participants are not allowed to speak because this is a webinar mode. All are on mute by the part.
Yeah. Okay, fine. Okay, fine. So maybe by standstill clause, I think he probably means moratorium. So yes, so well, actually there is no legal moratorium as such, even under the RBI framework. But if the lenders, in order to facilitate resolution and restructuring, they may voluntarily agree to provide some moratorium, but it is entirely up to them. And it will be entirely up to them to sort of not grant any moratorium and take the case directly to IBC and start the legal proceedings under the provisions of IBC. So I hope I have dealt with that issue. Next question is from Jatan. Jatan is asking if I had any views on income tax implications where shares have been issued at a discount and shares acquired at a fair value lower than fair value, considering that there is no specific relief provided in the Income Tax Act. Yes, Jatan, this is absolutely a valid issue. And though there is a provision to notify certain transactions, unfortunately, we do not have such notification at this stage. This remains an issue, and I don't know if there is a practical solution to it, especially where banks and others acquire shares at a significantly lower valuation compared to the ruling market price. In fact, I would like to share one insight here. In case of Yes Bank, in the notification that Government of India issued, the notification clearly states that it talks about capital gains, but I believe the intention is 56(2)(10), where it says that banks will not be liable to any tax, with respect to 56(2)(10). So I believe government also realizes this issue that may come up in case of a resolution. Another practical insight or a practical solution could be, see, in case of a listed company, it becomes very, very difficult because the quoted price may be completely different as compared to the infusion that may take place. So it remains a challenge, especially in case of a listed company. But in case of an unlisted company where the net worth is completely eroded and the 11 UA value is 0 or negative, if shares under 56(2)(10) are issued at face value, potentially you may not have issue under 56(2)(10), and 56(2)(7)(b) provision trigger only if shares are issued at a premium. So I don't know if that is a workaround in case of an unlisted company, and whether doing such a thing, is it prone to GAR, or there are avoidance issues with respect to that. But I agree, there is no clear answer issue with respect to this issue. Next question is from Priyanka. She is asking, wanted to know about NESL pillar of IBC, how practically it works. NESL pillar, I don't really get what she's trying to say. Maybe you want to, Priyanka, if you are still around, if you want to clarify in a subsequent question, that will be helpful. Next one is from Gaurav. He's asking, IBC applicable only to NBFCs with assets greater than 500 crores, or is it extended to HFCs too, given DHFL is one? Yeah. So let me clarify it. It is applicable to both NBFCs and HFCs with asset size of greater than 500 crores. But it is not applicable to other financial services player as yet, such as insurers or banks. So I hope that is clarified. The next question is whether the resolution plan, if approved by NCLT, is also binding on income tax authorities. Yes, Jatan. The NCLT resolution plan, if the resolution plan is approved by NCLT, it is clearly binding on income tax authorities as well. There was an amendment that was carried out in the IBC to make it very, very clear that the resolution plan is binding on all statutory authorities, government authorities, state government authorities. So I think that is very clear. And, we have a very recent decision in case of Ultratech Cement Nathdwara, where GST authorities had proceeded against that particular company for certain past outstanding open issues, etc., past issues under GST. And Rajasthan High Court has clearly held that once the resolution plan is approved, all past liabilities are extinguished. And it's a very good and speaking order which clearly specifies that the resolution plan is binding on tax authorities as well. Next question is, please cite example where GAR can be invoked. So, any transaction where the main purpose is tax avoidance, all of those transactions GAR can be invoked. So that's quite simple. And in fact, I cited one example in the course of our discussion. Say, for example, interest is converted into equity shares. Outstanding interest is converted into equity shares, and a deduction for such interest is taken under the provisions of Section 43B, and thereafter such equity shares are reduced under a capital reduction scheme. I doubt whether in such a situation one should really be eligible to claim the interest deduction, where the shares themselves are immediately cancelled after conversion of interest. So that is one example. Next question is, in case of loan used for working as well as others, then what will be the tax implication on stress company with reference to Section 41 and MET provision? Very, very, very good question. So we have Supreme Court decision in case of Mahindra and Mahindra, but the fact pattern of that case did not involve a working capital loan. It involved a term loan for acquisition of certain machinery. So therefore, a question arises that in case of a working capital loan, which would have been utilized for the purpose of paying to your debtors and so on and so forth, paying to creditors and so on and so forth, whether such a loan can be regarded as used for trading purposes, and write back of such a loan should be taxable under the provisions of Section 41. Now, interestingly, in the batch of appeals that Supreme Court disposed of while dealing with Mahindra and Mahindra's case, there was one of the cases which involved a situation of working capital. And this was a case of Rolla Tainers, India. And fact pattern in that particular case involved a working capital debt. So, and again, the Supreme Court ruling that 41(1) should not trigger is sort of binding with respect to that particular case as well. And subsequently, we also have a case of Compact Electric, where the issue was the borrowing had taken place with respect to meeting operational requirements of the company. And again, waiver of such borrowing was regarded as not taxable by Karnataka High Court as well as the Supreme Court. So, so these judicial precedents are there, but I would agree that there would still be some risk, and especially there is another Supreme Court decision in case of TVS Sundaram Iyengar, where Supreme Court dealt with whether such a write back can get taxed under 28(1). So, so as a planning matter, I would say that it may be very, very risky to take a view that working capital loan is not taxable, and it is better to see if there are other mitigants that are available, such as set-off of losses, etc., to mitigate the impact in respect of write-off of working capital loan as well as operational creditors. The next one, if the shareholding during the year changes by more than 51% and is restored at the end of the financial year, does Section 79 trigger and do tax losses lapse? So, if let's say shareholding changes pursuant to resolution plan under the IBC, then you have a clear exemption which is available. So this issue will be completely irrelevant in case of change of shareholding, in case of restructuring under IBC. But let us suppose, again, furthermore, if you have a situation of a listed company again, then the 79 figure is irrelevant. Only in case of an unlisted private company where change in shareholding is happening pursuant to restructuring outside of IBC, then a question of lapse of losses will become relevant. And the specific issue that you are highlighting here is that shareholder during the year changes more than 51%, and it is restored, the shareholding is restored back at the end of the financial year. So I think 79 is kind of, in that sense, very mechanical provision where you are required to look at the shareholding as of the last day of the year and compare with the year in which loss arose and the year in which you are trying to claim set off. So it may be possible to take a view that it does not trigger, but in a distressed asset situation, a shareholding change does not happen just for during the year. You would want an investor to come in for a long period of time. Otherwise, lenders may question viability of the resolution plan. So I don't know if this fact pattern will ever emerge in case of a resolution plan. Next question is whether income of the securitization trust be business income when a non-resident is holding PTC certificate. What will be implications of TDS? Whether securitization trust will be regarded as PE of non-resident and TDS will have to be at 40%. Yes. So this is a very interesting question by Chetan. As I highlighted, the securitization trusts enjoy a pass-through status. The ARC company is typically the trustee or the settler of such a trust, and then there are independent trustees who are the trustee of such a trust. The trust itself, has a pass-through status, so that if trust earns business income, then the characterization in the hands of the investor should also be that of business income. And here the question of the participant is, can securitization trust itself be regarded as a PE? So one will have to look at this from the definition of permanent establishment. Whether the control, the investor holding PTC certificate do not necessarily have control over the securitization trust, which rests with the trustee and the who sort of controls and has the legal control with respect to securitization trust. Investors may have certain rights as part of their subscription to PTCs or security receipts, but those are rights similar to any other investor that would typically have. For example, if a non-resident is holding equity shares, then then right to dividend or right to vote, similar rights would also be enjoyed by the security receipts holder. But they themselves do not control the securitization trust, even if they hold a substantial amount of security receipts. So ordinarily, I would not consider that securitization trust be regarded as a PE, because it is acting in its own capacity and it is not controlled by the non-resident investors. So, one would have to look at if it can fit in any other limbs, that are applicable under the PE definition, such as service PE or dependent agent PE or fixed place PE. But ordinarily, I would regard them to be two distinct persons, which are where one person is not controlled by the other, and therefore this will have to be independently evaluated. But in plain vanilla fact pattern, I do not feel that trust can be regarded as a PE. But obviously, there could be different views. The next question is again from Mr. Chetan, whether PTC can be regarded as capital asset. An extinguishment of the same will be liable as capital gains. Yes, surely, capital in the hands of the investor, PTC, if the investor has invested into PTC or security receipts in the capacity of an investor, and the investor is holding such PTCs as a capital asset, then such PTCs can surely be regarded as capital asset. And further, these security receipts are freely transferable. So even in the during the tenure of the PTCs, it can be sold by one investor to another, and therefore, if there is any gain, it can be liable to capital gains tax. Next question is from Mr. Bharat. How do you treat GST implications in structuring? So yes, Bharat, I must apologize that I have completely ignored GST in my entire presentation, and that is because I do not understand GST at all, and I'm not a indirect tax professional. But what my general understanding is that so long as there is transfer of business as a going concern under the indirect tax laws, there should not be any supply that should arise. And I believe there are exemptions available for transfer of business as a going concern, so that GST would not apply. I hope and believe that rule should be applicable even in case of restructuring, in case of a stressed asset. Next question is from Priyanka. What to be done if director own personal assets are mortgaged and asset co also mortgaged? Now company has received letter from SARFAESI. Well, I do not understand the question particularly, but my understanding of the principles of law is that director, let's say if he has given any guarantee, or if he has mortgaged any personal assets, then okay, so it depends whether the borrower is the director concerned himself or the company. And if the company is the borrower, then the IBC proceedings can be initiated against the company. If the borrower is the individual director, but the security has been given by the company, then my understanding is that the lender will be able to proceed against the company as well, even in that case. And in fact, there may be some issues around enforcement of such security interest, etc. Because very recently, Supreme Court, in case of JP Infratech and Jaiprakash Associate Limited, has made certain observation where borrowing is by one entity and security is provided by another entity, and they've regarded such transactions to be of preferential nature. So banks' ability and enforceability, may be sort of constrained in view of that. But of course, will need to be analyzed in considering the specific facts. Next question is whether asset stripping is permitted under IBC. Asset stripping, matlab selling of assets. Yes, assets can be sold if as part of the resolution plan. But the whole idea and genesis is that the resolution takes place as a going concern, so that asset stripping should not result into the company losing its going concern status. So that will be important.
Kushal, we will have to take the Kushal, we will have to take the last question.
Sure.
Yeah. Whichever you find interesting,
so
you can take the last question, whichever you have find.
Yeah, so sir, there is one question from Mr. Dharmesh. He is asking, under IBC, if the corporate debtor makes payment to the guarantor to whom the guarantee is given for loan taken by the group company, and the corporate debtor is to be treated in the books of corporate debtor and its implication and the income tax law regards. Okay. So here, I think here the key question is that if the guarantee has been given in respect of certain loan taken by the corporate debtor, and the guarantee is invoked, and therefore director is asked upon to make the payment, then how would it be treated from an income tax perspective vis-a-vis the company? So Dharmesh, there is a concept of subrogation under the general contract law, And basically what happens is that if a particular party meets the obligation of the another party, then the party which meets the obligation steps into the shoes, for example, here, the corporate guarantor would become the lender, so to say, depending upon the extent to which the liability is met by him. This does not mean that corporate debtor's liability is extinguished. His liability will continue to remain to the corporate guarantor who has met the liability. So merely the guarantor has discharged the liability, it should not immediately trigger any tax implication for the corporate debtor.
Thanks, Kushal.